All right. Well, hello, everyone, and thank you for joining us or watching this video again. You may have seen our last little video we did like this on cash flow bullets, and I've got Bob again with me today. How you doing, Bob?
Doing great, Davey. How about you?
Doing well, thank you. Bob, we're here to talk to people today about maximizing the value of their business. And, this is something that we really do on an everyday, every engagement basis with our clients, whether they realize this is what we're working on or not. Really, as a business owner or an advisor, business valuation should always be at the top of mind.
Absolutely. And it's really a long-term look for the business owner, and I'm a small business owner as well, and we tend to get caught up in the day-to-day and short-term events and shorter-term profits, but every business owner needs to be looking at where do I want this business to be in the long term? How can I maximize the value of it, not only for their self and their family, but their employees, other stakeholders? What impact can they have in the community? So it involves a lot of different factors. But yes, as you said, we work on this every day. Even some of our clients don't realize some of the things we're working on
Right.
are helping with this.
Well, before we can talk about the actual valuation, we've got to get some housekeeping and some terminology out of the way. And one of those things is EBITDA, right? So a lot of people have heard this word or phrase or whatever they think it may be, but maybe they don't know exactly what it is. They know it's something to do with profit, something to do with finance. But Bob, walk us through what EBITDA really is in layman's terms.
Sure, be glad to. And you've got a great little graphic here that I think visually explains it. EBITDA is simply an acronym for earnings before interest, taxes, depreciation, and amortization. And what that does is it takes out the financing of a business, because some businesses are highly leveraged, some aren't. So we take the interest expense out of it. We take taxes out of it because different entities, some people are LLPs, LLCs, sole proprietorships, partnerships, C Corps, S Corps. So we take the tax out of it. And then we take those non-cash GAAP requirements, depreciation and amortization. So we're left with what we think is sort of a pure earnings number. And EBITDA is also the theoretical cash flow generating ability of the business. And at the end of the day, the amount of cash flow that a business can generate really tells what the true profitability is. And that's the baseline measurement for what that company is worth.
Well, when you hear EBITDA, a lot of people think like, corporate finance, Wolf of Wall Street, Fortune 500 companies. But EBITDA is something that business owners of every level truly need to be aware of.
Absolutely. And we work with a lot of private equity companies who invest their portfolio in family owned and privately held businesses. I've never seen any of them not heavily rely on EBITDA. It's just a good, strong, common measurement of the profitability and the theoretical cash flow generating ability of that business. So everyone from an exterior standpoint, external to the business, looks at it. So if the external users feel it's important, the internal users and the owners should feel it's important as well.
Well, Bob, let's look at this actually in practice here. Okay, so we've got two bakeries. We've got Joe's Bakery and Susie's Bakery, and from all outward appearances, these are very very similar businesses. So they both did $1 million in sales, and both had the same cost. But looks like Joe's business edged her out, made an extra $50,000 in profit.
Well, bottom line profit, that's absolutely correct. Joe's a little bit more profitable, but notice the depreciation, interest, and tax is $100,000 on Joe. Those are all EBITDA add backs, and on Susie, there's $150,000 add back. So when you look at those differences and compare, that's going to basically mean that their EBITDA is the same.
Well, okay, so depreciation. So Joe had $40,000. Now Susie didn't have any depreciation. So give me an example of how that can be. That I mean, because they're both the same type of bakery. How can one have so much depreciation and one have none?
Well, particularly in the bakery business, and my daughter actually is in this business now. She's looking at renting a commercial kitchen. So Susie may be doing that. She may be renting her equipment rather than owning that equipment and then depreciating it. So Joe would have more capital investment and be depreciating it, where Susie is renting the use and access of that equipment.
Well, that makes sense. And, I guess the interest expense, boy, Susie's really paying quite a bit more than Joe when you look at that interest. It doesn't look like she did as favorable with her financing terms.
It could be the financing terms. That's certainly correct. Different credit scores may be causing her to pay a higher interest. She may have purchased a franchise, and she's borrowed a lot of money for startup capital and be paying that back. Joe may have started his out of his own pocket, or may have had less startup costs to start with. So their capital structures are different. Therefore, their financing costs are different.
Well, speaking of different capital structures, even though Susie made less money, looks like she paid more tax than Joe.
Yeah, she could be in a higher state income tax state. Her entity status could be different. She could be a C corporation, be having a higher tax rate than Joe. He might be an LLC or a sole proprietorship, a pass-through entity. Um, so, yes, their entity structure makes a difference on how their tax structure is as well. So those are the kind of factors we like to take out of it. Those are owner decisions about all of those issues that impact the business, but they don't have anything to do with the theoretical cash flow generating ability of the business. This is how they're spending, not necessarily how they're generating profit.
Well, let's go ahead and take those out, the depreciation, the interest, and the tax. And would you look at that, Bob? The EBITDA is the same on both businesses.
That's right. You factor those components out, and now those businesses to an outside investor or to Joe and Susie from a financial standpoint look very, very similar. So that's the reason we factor these things out, is to try to get an apples to apples rather than an apples to orange comparison when we're looking at various businesses.
Well, I can see how an outside investor at first glance, it might look like Joe was doing better than Susie, but when you look at things that may be different, if an investor comes in and were to purchase Joe's Bakery, they may change the capital structure. They may change the debt financing. They may change what's owned versus lease on the equipment. So really, those are all variables that can change with ownership, can change with location or personnel, but the EBITDA is the same.
That's right. That's right. Because any potential buyer or even a current owner should be able to look at the structure of all that and determine what's best for them. What's best for Joe may not be best for Susie, and that's okay. But those are decisions you make on the individual business basis. But from a comparison standpoint, if I'm an investor in a bakery, these two bakeries at this point are looking very similar.
Well, Bob, we're going to go ahead and take a break here. And when we come back, we're going to talk about how EBITDA is one of the variables in our business valuation equation.
Sounds good.